Good, good. All right. All right. So now it's 8:30 and we have 225 people in the call right now. And with more members joining us, I expect a new record for today as well. Because I think last time we got something like 400 members or more. So let's see how many people we have today. But I'm glad that our community continues to thrive and grow. And I can see the level of participation that you are having uh, because the number of questions and the list of ideas and topics and trade ideas that you send in just just speak for itself, right? All right. So let's now get into the agenda for today. As usual, I will cover the market update and also followed by the review of the gathering trades, including those that have closed and those that are still open in the portfolio. And also the overall portfolio performance for the past 4 weeks since I entered the trades. Remember, I started this year with a brand new account for this particular group with $50,000 net liquid, and let's see how it is performing. And also, then we'll jump right into the on-demand topics. As I said, I have like 31 topics that people ask me today, and then the live trading as well, right? So let's spend like very quick, maybe 10 minutes on the market updates, and then we got into the other part. Otherwise, we are running out of time. So market has declined actually over the past 4 weeks, and mainly the decline came last Friday when S&P 500 dropped nearly like 2%, right? And that is something that I observed recently. The market tends to be under pressure on Friday because with Trump's administration and his unpredictable policy and the announcement that he could make during the weekend makes people nervous ahead of the weekend. And many times we see that he will announce something during the weekend and the market just tumble on Monday. Like we saw it many times. So people tend to take profit off the table on Friday. And that could explain why last Friday we see a big sell off. Yeah, there was some news, but not a major one. So I would attribute the sell off to the usual suspect that I have, which is people is nervous ahead of the weekend. That's it. And pre-market today's indicates a strong opening. Let's see if it can stay there. If it can rebound today, I think the trend should be fine, right? But if it breaks below the close on Friday, then it will be a little bit more concerning, right? So overall, past 4 weeks, SPX actually went up and set new on-time highs, and it, as I said, it declined on Friday and it closed uh, down for 1.4% versus 4 weeks ago. However, because in January the index was up, so year to date, SPX is still up by 2.2%, right, as of last Friday. And you can see it from the Thinkorswim chart that I will share with you as well. So let's show it here, S&P 500, right? So the rectangle, the green one, is how S&P 500 has moved over the past 4 weeks, right? So we met here on the eGathering in January when the market has a big pullback, and then it rally and then pull back again, rally, pull back again, rally, and pull back again. So it's like dips on uptrends, right? Dip on uptrend. And looks like big sell-off happens Friday, right? Sometimes it happened on Monday as well, but looks like the opening of the week, normally the momentum is strong, but towards the weekend it get weakened, and then maybe there will be some sell off on Friday or on Monday if there's a big announcement during the weekend, right? So that's what happened. Now on GLD, which is gold ETF, has been performing very well. So it's up for 5.9%, and this is on top of the 6% gain in the previous month as well. So gold, obviously, you see the trend is very strong, and it's now at the all-time high, right? And understand it can be explained by the fact that there are still a lot of uncertainties in the market itself, like the geopolitical. I mean, you keep hearing the Russian and Ukraine thing all over the place every single day, right? You hear something like on even the Israel Hamas thing still not like completely settled, and then we have potentially trade war in many places, right? With the tariff policy that Trump's announced, so a lot of uncertainty is going on. That's why people continue to park their money in gold because it is perceived as a safe haven, right? Now, having said that, gold has stayed overbought for quite an extended period of time. So I would not be surprised if there is a sharp pullback, especially if there's a resolution on the Russian and Ukraine war. The peace pact would be signed or something, then we could see a big collapse or pullback on gold price. Yeah, TLT on the other hand has recovered, and it's still on a downtrend though. TLT, right? You see here, the trend is still down, right? Looks like it's still like lower highs, lower lows kind of pattern. So I'm not convinced that the recent recovery of TLT is the bottom already, right? I think it could be just like a rally on the downtrend, yeah, rally on the downtrend. And I'm not bullish on TLT for sure, yeah. Next, oil price declined almost 6% over the last 4 weeks. Yep. And now it has broken down below the support level. This is a very strong support. It used to be a trading range until it broke above that. And then since Trump like won the election, and then his policy of drill baby drill, and then the market is afraid that there would be more supply than demand, and therefore the price has been going down. Yeah. And now if Trump is friendly with Russia and allows Russia to sell their oil, then there could be even more supply in the market, and that's why you see it could put a lot more pressure on CL, which is oil price. For now, technically, I look at this chart. I'm still bearish on this one, and I see it could be heading towards support here, which is at 67. Yeah, so that is how I interpreting the chart of oil price. VIX was up 3 points. It's mainly due to the last Friday spike, right? Last Friday, VIX spike about 3 points, and that's it. Other than that, it has been flat, fluctuating between like 15 to 20 level, depends on where the SPX is, but it has been fluctuating in the range, right? Bitcoin, on the other hand, dropped right after it set new on-time highs after Trump's victory, and he's issue his own meme coin and his wife's meme coin as well. A lot of hype was going on, and then now it's fizzled, right? It's fizzled out, and Bitcoin declined 4%, $4,000 since last time we reviewed it. And we have a trade on BIT, IBIT, right? So IBIT, this is a Bitcoin ETF. The trade is doing fine though. The trade is doing fine. Yeah. Now on the economy and policy and politics, of course, the key focus has been on the inflation data, right? And the inflation report, the CPI report, actually was hotter than the expectation. The January report, right, which released in February. So it up 0.5% in January versus a prior month, and that is hotter than the expectation 0.3. And there was a sell off, the market sell off on that news, because that would mean the Fed now will push the rate cuts further into the future, right? And I just checked the Fed Watch tool. The market is now expecting 25 basis point cut only in June, and not even at a high probability, right? It's less than 50% chance, 46% probability that the Fed would cut rate in June, and if any, possibly another one in December. But the probability of that is low, 33%. On the other hand, in early Feb, we saw the employment report, the non-farm payroll, that was weaker than forecast, right? Now, in terms of the market outlook and opportunities from here, obviously we experienced a sharp pullback on Friday after the SPX hit the record. But as I said, it is very understandable because the market is at that point in time it was way overbought, right? So it's just one way the market works it off the overbought condition. But look at the trend on the SPX. It clearly is still on the uptrend, right? SPX here, you see the trend is still very solidly up with all moving average sloping up, right? 50, 150, 100, 200, they are all sloping up. Even the 20 and 40 EMA, they also sloping up. So the trend is still very intact. The remaining solid uptrend still there, right? So the recent decline, in my opinion, could well be just another dip on uptrend. Yeah. But given the high volatility of the market in these days, I prefer to use risk-defined trades. So when I say risk-defined trades, those are the trades that when you enter, you know exactly how much is the max loss, and the buying power is blocked for the full amount of the max loss. So if the price collapses, it won't increase the max loss. It won't increase the buying power. Right? So that is called risk-defined trades. Calendar, diagonal spread, Bunbang collar, Diaz hammer, those are risk-defined trades. Even Bund put spread and Condor, ESS, EPS, they are all risk-defined trades. There are only few trades that are not risk-defined. Cash secure put is one, crouching Bund is two, and then Trade Lizard is three. Right? So these three strategies, whenever you deal with selling a short put, I mean a short put without a protection below, that is undefined risks, right? Undefined risks. So when the stock price plunges, you will see the max loss can be significant and the buying power will surge a lot, right? So those are the one I would minimize. I minimize unless I want to do it on fundamentally good stocks that is undervalued and on a very bullish technical setup. Then I could use cash secure put or I could use crouching book, right? There are a few good stocks that are still undervalued, right? And many of you actually suggested to have some trades on it, right? It's like Amazon, Google, and Microsoft. So we go through all of these because definitely those are the ones that this is under my radar screen, and I may enter the trades as well, right? All right, so let's get into of portfolio performance. So this is the account that I used for our trade last time. Remember, I started the year with a brand new account here and with the capital of $50,000, 50K. Right now, it's gone up to 53, right? So apparently, within the last 4 months, I got a profit of $3,000, right? I grew my account by $3,000. So imagine $3,000 divided by $50,000 capital. That is 6%. Not bad, right? 6% a month. In this case, like 4 weeks, right? It's a decent idea. Despite the fact that this is a decent performance, despite the fact that the market has dropped, right? 1.4%. I mentioned SPX is down 1.4%. And this portfolio is doing fine. Doing fine. And I tell you that, you see many of our stocks are actually not doing well, but the trade is doing well. And that is the beauty of calendar spread. So in January, maybe you can call it a luck. I use many calendar. I use calendar spread on many trades. Now, it's not my own idea to come up with those trades that and I use calendar spread. Remember, all the trades I executed came from your ideas, the one you sent in. So some people ask me, how can I enter so many calendar spread and not using other trades, other strategies? Well, it all came from yours, right? If you want me to look at other strategies, just throw idea in or suggest the trade ideas. I will consider. But these, I mean, the over uses of calendar spread in January was actually came from your list of ideas, right? So it's not mine. It's not mine. But keep in mind, we also have a few other trades as well. We have I think we have a diagonal spread on DocuSign. We have the EPS trade on Meta, which did well, and we have the ESS trade on Walmart, which also profitable, right? So we have other trades, but majority of the rest of the trades has been on calendar spread. And it turns out to be a good thing because in a market that has been like going sideways or up and down a little bit, right? In this case, declining a little bit, calendar spread is a good one. Calendar spread works very well in that particular market condition. So if you expect the market to continue to go sideways or declining a little bit, not collapsing, I would still prefer to use calendar spread, to be honest with you. Yeah, of course, if you think the market will fly much higher from here, then you probably want to use more bullish trades like diagonal spread, like Boon Bang color, like crouching Boon, or even Boon Bang, right? Yeah, but just keep in mind in the current market environment when the market is still working off its overbought condition, I would still favor I would still favor the calendar spread. Right? But again, trade ideas come from you. Yeah. So let's go to the list of the trades here. And let me start with the trade that I have closed. And then later on, I go to the trade that are still open. Right. As usual, after today, I will update this update this tracker with the new trades. And any trade action I'm planning to take today for those existing trade here, and then I send it out to you tomorrow for your reference, right? This is for TOS, right? But if you want to use it for IBKR, I do have a template for IBKR as well. Just go and download it from the curriculum, okay? Now, let's go to the close trade here. During the month, I closed only 3 trades. The first one was calendars turn diagonal spread on Netflix. So remember Netflix, I entered during the last gathering. That is on 27 of January, 27 of January, which is here. This is the entry point. 27 is this day, right? So the background was that Netflix released a very good earnings report and the stock price jumped higher and then it pulled back a little bit and it is consolidating. So that's a good setup for a calendar spread. That's what I normally observe when the stock price jump after the earnings. It normally will not like continue to go up many days in a row. It tends to retrace a little bit and spend some time to consolidate and eventually go eventually goes higher from there, right? That's a very typical setup that I've seen in many stocks. So because of that, during the consolidation period, I enter the trade as a calendar spread. Remember, calendar spread will benefit if the supply goes sideways, consolidating kind of pattern. And this is exactly what happened to Netflix, right? So the first few days after I enter the trade, the stock prices continue to fluctuate around my entry point, and because of that, I could run the short call to collect more premium while waiting for the stock price to go higher. And I run it one, two, three rounds. The first round, actually, I run it up for a small debit, but then when the stock price started to go higher here, you see the stock price after the consolidation, it shoots up to the higher level, and that's where I kind of play catch up a little bit, right? I run it up two times. So total, I run it up three times, and I pay a debit for the rolling. I pay a debit for the rolling, but I created a lot more headroom for the upside. So the good thing about rolling up, right? When you roll it up and the supply continues to go up, that will bring more profit to the trade. The worst case scenario would be you roll it up for debit, and then the supply collapses. So that's the worst case scenario. But this is not the case here. So in this case, I roll it up, the supply continue to go up, and it goes even higher than my short call. So I close the trade on Feb 13 here. And on that day, when I close, if you go back to my notification, I say that now that the stock price has gone beyond the short con strike, which is $1,000 here, I say it would be risky to roll the short con up and pay a big debit when the stock price was overextended. That's what I said, right? So at that on Feb 13 there, if you go to the chart of Netflix, Feb 20th, Feb 13 is this point, right? So I say at this point, it's too risky to roll it up and pay a big debit because the stock price is overextended. And then I say, I decided to close the trade to lock in the profit. It's not like at my profit target yet, but it's okay. The profit is decent, right? And because I just don't feel comfortable rolling it up for a debit when the stock price is overextended. And sure enough, after I closed the trade, the stock price started to retrace, right? And that is a good thing, because if I have paid a big debit to roll it up and the stock price retrace like this, it would hurt the trade, right? So it's a good decision that I made there, right? I do not always get the timing right, but in this case, I got it right, right? So that's why I avoid turning the profitable trade into a losing trade, right? So that's a good trade that I made there. Number one. Number two, this is easy one and low touch kind of trade. So you enter and you exit. There's no repairing, there's no rolling, nothing. So I enter the ESS trade following exactly entry criteria. And then when this is just one day before the earnings, right? The trade hit my profit target. Actually, my profit target is anything more than 50%. That is good enough. The absolute profit is small because the risk is also small, right? But it's okay. It hits my profit target. So I just get out and then close the trade. I'm happy with 61% profit, right? Number three, meta trade. And for this one, we did well also, right? So remember during the webinar last month, I asked the team, all of you here, what direction you think Meta price will move after the earnings? And all of you say, most of you say up, right? So that's why I picked the bullish side for the trade. I picked the bullish side for the trade. And Meta released earnings and the stock price went up, and I closed the trade a little bit early because I afraid that it overshot on the upside because it went a little bit way over to the profit zone. So I closed the trade, locked in a 100% return on investment here, but I know Some of you close it later when the stock price kind of retrace back into the profit zone, and that's where you get more than 100% return on investment. But I'm happy with my trade 100%. So it's good. And thank you for a good suggestion there as well. Later on, when we do one more EPS trade, I mean, I know many of you suggest EPS trade as well, but again, it's a low probability trade, right? So it's kind of um, binary event, whether the stock price goes up or down after the earnings. Anyway, later on when I um, enter one EPS trade, I will ask you to give me a poll on where you think the stock price will go up or down after the earnings. But anyway, we have three profitable trades here, close, realizing $1,227 profit. And on top of that, we still have the trades that are still open, which is 1, 2, 3, 4, 5, 6, 7, 8. 8 trades are still open here. And those 8 trades are sitting on an unrealized profit of $1,772. Yeah. Among those 8, 6 are profitable and two are losing. Yeah. So first of all, the ETF on Bitcoin. So this is a calendar spread when I entered the trade 4 weeks ago when the ETF price is around 57. And since then, the ETF price has dropped about $3, right? From 57 now to 54. So the price has declined. However, we're not investing or something here. We're trading. And the beauty of calendar spread is that when the stock price decline, but not significantly, like this case, the trade would still be doing fine. So in this case, the trade is still profitable. And part of the reason is I have been able to run a short call to collect more premiums. So I have run it 2 times. So every time I run to the same strike price, which is 57, to collect more premium and realize the profit for the rolling. And I have run 2 times for that. And that helped underpin the impact of the stock decline, right? So the long call is actually losing money. The long call is losing money, but the short call has realized $1,287 plus the unrealized gain 114 here. So these two combined more than offset the loss of the long call, right? So you add 114 here, and then you might 114 here, and then these combine, you minus the loss in the long call, and that's where you have $261 profit. So that's the whole idea of calendar spread, right? You keep rolling the short call, collecting more premium. So even when the stock price goes sideways or declining like this, the trade should still be doing fine. Now, next one is even more clearer, right? Even clearer, right? Next one, Intuit. I also enter it as a calendar spread at the $600 strike price, which was around near at the money at that point in time. The stock price, however, since then has declined 35 points. Yeah, the stock price has declined 35 points. But yet, the trade is making good money, right? It is making like $450 profit. And the reason for it, same thing. I have rolled the shotgun 1, 2, 3 rounds. And the profit from the short call from 3 rounds of rolling that I have realized, $2,180. Plus one more that is still pending, right? So this one has not realized yet. So if I combine this one with this one, the profit from the short call alone is more than $2,500. Yeah. So that is more than offset the loss that I'm having now on the long call. So that the whole idea is, as long as you collect more premium or profit from the short call versus the loss in the long call, the trade should still be doing should still be okay. Again, this is one more time. It proves that calendar spread works very well,
It's 9
even when
o'clock.
the stock price decline slightly. Not slight, in this case, not even slightly. It's quite significant, right? It's like 7% drop in the stock price. Yet the trade is still profitable. The key thing here is when the decline happens. If it happens right after I enter the trade, yeah, so that will hurt the trade. But if it happens after I have run it for a few rounds, like in this case, then this is fine. Then this is fine. Yeah. So it's important to realize some profit first before the decline happens, right? That would be doing well for the trade. Right. So this happened to both trade, the IBIT and also the Intuit. Now, MU is a different scenario. In this case, the stock price has gone up. So I enter the trade also as a calendar spread, but now it has become a diagonal spread. The diagonal spread here. Right? So it's now become diagonal spread because I have rolled it from 90 strike price, the short call, I roll from 90 strike price up to 95, right? To create more headroom for the upside because the stock price has gone up quite significantly. Right now, the stock price is trading at 99. So actually last week it went beyond 100, but it pulled back on Friday. So it pulled back $4 here, and it now down to 99. And 99 is still above the short con strikes, right? And well above the entry points, which is 90. I entered the trade at 90. So MU has gone up, and I roll it up, and the stock price continue to go higher, which is good. That's why you see the trade is making money, because I roll it towards the stock moving direction, and that is good. Now the pullback happened, but it did not pull so much below the short call. In fact, it's still above it. So that's why the trade is still doing fine. Yeah. The best scenario, of course, would be the price continue to retrace towards the short call, the 95 here, as the time is running out in the next 2 weeks. So that would be the best scenario. And right now, I just stay here because I look at the chart of MU earlier. Um, I think the pullback could continue in the short term, right? So MU. So it has been trading in a range. You see it trading in a range like this for a long period of time. So last time it hit this resistance level again. Every time it hits the resistance level here, it looks like it could not break through it. And it hit that and then it pulled back. So I think it could pull back a little bit further from here, which should do well for the trade because I wanted to pull back towards the 95 by the expiration. So I'm not taking any action here. I'm not rolling it up. I just keep it there because if it continue to go lower, it will be better for the trade. So the trade is doing fine. I'm not taking any action also because the trade is not hitting my profit target yet. Remember, my profit target 50%. Now it's 31. Yeah. Next one, this one also doing well. Calendar spread on dollar tree, and I entered it, and this is the best scenario. This is not the IBIT, this is not Intuit, it's not MU. So IBIT, it went down, remember? Intuit also went down. MU, it went up. This one completely flat sideways. And that would be a ideal scenario for calendar spread. So calendar spread, if the stock price goes like sideways for a long period of time, it will be the best scenario for a trade. So I keep rolling the short call for many rounds, collecting more premium because every time I roll, short call will be expired worthless and I will roll it to the next term, right? So how many rounds I have rolled here? I don't know. I should have recorded it as a formula. I think I have rolled it 2 times. I can go back here. $3 $3 over the past, let's say 30 days. Yeah. So how many times I have rolled it? Trade history. So enter it, roll it once, roll it twice. So I roll it twice, right? So I roll from 75 to 75. 75, roll it to 75 again, right? This one is a split order. So I rolled it twice and I realized $900 plus for the for the short con profit, right? And the long con is losing some money, but the short con keep collecting profit. So then the trade doing fine. And you look at the chart of dollar tree here, it looks fantastic for a calendar spread, right? It kind of lies flat, right? And that is good for the trade. Now, one thing, keep in mind, I may need to take the money off the table on this one early before the earnings, right? Before the earnings. Earnings coming in the next, I think, 2 weeks, mid-March something, about more than 2 weeks, about 3 weeks. So middle of March, there will be the earnings. That's so before the earnings, if I forget, somebody need to remind me, I will need to take the money off the table here. And the reason for it is this stock tends to gap a lot on earnings, right? And then I don't want uh, to to let my profitable trade to turn into a losing trade because of the gapping, right? You see in the past here, it gaps a lot, right? Gap down here on earnings, right? It gaps significantly here on earnings as well, right? So I don't want to let my trade at the mercy of the market. So I will lock in the profit before the earnings, even if it has not achieved my 50% target, because the risk of gapping. I realize this one and the Dollar General, the same. Dollar General, the same industry, the same business model, right? They tend to gap a lot on earnings. You see, Dollar Trade General, they have the same issue of gapping here, right? On earning gapping again, right? So I just want to be prudent before earnings. That's it. But right now the trade is doing fine, making 19% profit. So I still can roll it for 2 more rounds, right? This Friday, and then after that I will can roll it one more time. And then after that the earning comes, and then I will close it. So I'm not rolling right now because there's still a lot of value in the short call here to hold. Next one. This one is a bit tricky. This is not an ideal scenario. Though the trade is still profitable, the McDonald, but this is not the good scenario for calendar spread. So I enter the trade as a calendar at 285, and the stock price just went up. I roll it to 287.5 and roll it again to 290. And I pay a big debit for the rolling. That's why you see a big, I think I rolled it only once, not twice. So McDonald, yeah, I rolled it only once from 285 to 290. No, I did not pay a big debit. I pay only 50 cents, which is fine. But it's not enough because the stock price went way above that. It went to like 300 plus. And right now, it is well above the short call. And in this scenario, I call the trade stall. Stall, right? It's like when you drive a car and you press the accelerator too fast. What happened? Your car will be stalled, right? Like that, right? So the same like this one, you enter the trade, then stock price went up so fast, and the trade is stalled. Stalled means you don't have a big risk on the upside, right? Because your long call is still deep in the money also, so it will benefit from the stock price going higher. But you cap your upside already. You cap your upside significantly. If you want to create more upside, more headroom for the upside, you will need to roll the short call significantly up, right? Then you have more room for the upside. But at this stage, if the stock price doesn't retrace back to the 290 short call here, your trade will be stalled. Yeah. So what do I want to do with the trade, right? Because a short call delta is 994. So if it goes higher, it will hurt the trade, but the theta will help the trade. So kind of offset each other. You have a delta hurt, but you have a theta gain. So every day, if the supply goes up a little bit, the trade would still be around break even or $100 profitable like this. The best scenario would be for the McDonald's stock price to go back down to 290 in the next 7 days here. And that would be the best scenario. right? So then it will depends on my judgment on where I think the supply will go from here, right? So then I go to the chart here. What do I see? Well, good thing that the retracement has happened, right? And it has gone down from the overbought, but now it looks like it near kind of oversold already, so the stock price could go a little bit higher from here, right? Or neutral. So from this chart, I don't think the pullback will continue, or at least for any major magnitude. Then I need to consider whether I want to roll it up or not, or I just close the trade and happy with $100 profit. All right. Really, if I need a capital, right, I just close the trade because it's stone already. Just sell it, close it, take $100, and then use it for a new trade. That's what I can do as well. But I will explore whether I can roll it up for a small debit. Then I will do. Right now, I don't think I can. For example, if I buy this one back 290 here, and then let's say I roll it out for to like almost 3 weeks, and I roll it to 300, right? Right. So from 290, I roll it to 300. I need to pay quite a significant debit for the rolling. Yeah. I don't feel comfortable with this rolling unless I'm so bullish that the supply will go higher from here. And remember, the 300 is still in the money. It's not even near at the money. At the money is right now is 204 to 304, 305. This is still in the money. So it still capped the upside, but at least it has more room for the upside. Yeah. So by rolling 10 points up like this and paying like 7.8, I will create about $2 and $2.20 exchange value extra or additional headroom for the upside for the trade. So then something I need to consider. Otherwise, I should leave it there. I should leave it there, see if we can retrace or not. If not, then maybe I just close the trade with a break even or small profit if I need capital. Yeah. So there's not much risk on the upside, right? Not much risk on the upside. So I leave it there for now. Later on, when the market opens, I will consider rolling again. If not, I just leave it there. And if I need capital, I just close it. Yeah. DJD is similar to IBIT and Intuit, right? However, the decline in the stock price is more severe, right? From 31, it down to 27. Still 4 points, but on percentage, it's more. It's more. And then I have rolled this one for 2 rounds, but the trade is losing money because the magnitude of the decline is more than the IBIT, right? So in this case, I just wait and see. There's still plenty of time in the trade here. I still have like 7 months in the trade on the long call, so I keep holding on to it. And unless this one hit my 50% return on investment negative, I would hold it and keep rolling the short call. And the short call has pretty decent premium, so I keep rolling it. So like right now, the one that expires in the next 2 weeks here still have $330 exchange value. So once this one expires, the exchange value here will translate into a profit and would reduce will reduce the loss for the trade, right? So I'm holding on. I'm holding on. And if there's a recovery in the stock price, it will be even better. Yeah. SMH is similar to SMH is similar to MU. SMH is similar to MU. I have rolled the short call up. I also enter it as a calendar spread. Now it has become a diagonal spread, right? Also diagonal spread now. Right? So I rolled it up, SMH, right? So I rolled it up twice from 240, I rolled it to 245, and 245, I rolled it up to 250. So so this one I got a credit, but the second round I pay a debit. And it was good because the stock price has gone up, and right now it's right at the money. 249.99, so 250. So this is at the sweet spot. I call it sweet spot, meaning right at the strike price of the short call. That is the sweet spot of the trade. The longer it stays here, the more profit it will generate for the trade. Imagine this one, the short call here, the 250 will expire in the next 2 weeks. There is more than $1,000 worth of intrinsic value in it, and this one will go to zero at the expiration. And where is it going to? Well, it will increase the profit for the trade. So right now, right at the sweet spot, leave it there, don't touch it, right? Just keep quiet on it, let it work its way. Yeah. So that's a best scenario I would call in this case. So there are two best scenarios. One is if you enter the trade and the stock price goes sideways, like the dollar tree, and you keep rolling to the same strike price. So that's one of the best scenarios. This one also considered as a best scenario because you roll it up and the stock price goes right at the strike price of the option that you just rolled to. That's another good scenario as well. So that's why the trade is also making good profit here. Finally, this is the bad trade. The stock price decline. This is actually when I entered as a diagonal swap. That means I was very bullish on the stock rally, right? So that's why diagonal spread is more bullish. So I entered as a diagonal spread, but after I entered it, the stock price actually went down. So from 95, it went down all the way to 84 now. So $11 down. And in the last round of rolling, I rolled it down actually. Now it's become calendar spread. Right. So because the short call, when I roll it down to 95, which is equal to the long call strike, the trade becomes a calendar spread. And yes, I collect premium from the short call and I close the short call for profit, but it's not enough to cover the loss in the long call. And because of that, the trade is losing money. Yeah. So that's the whole review of the portfolio. I hope it is helpful. So we have 3 closed trade which are profitable. We have 8 open trades. 6 of them are profitable and 2 of them are losing money. In summary, we have $3,000 profit for the month, including 1,002 plus for the realized profit and $1.8 thousand unrealized profit. Right. So that is a gist of the portfolio review. And that is the summation here. Now look at the performance based on the longer horizon. Now we just have 1 month for the year, but as we go along, there will be more months and we will review monthly and then year to date as well. So 2025 here is a year to date, right? Apparently. And it's a good start for us. For those who are not in this community for long enough, you know that we've been doing this for many years. There was time when we lost money, like in 2022 bear market here, but for the rest of the years, we was very profitable, right? So if you add 5 years plus this month combined, we got close to $36,000 profit, and that is like 132% return on investment. On the same period, SPX was up by 90%, right? So obviously we overperform the market. Right. So before we get into the topics and questions, any burning questions? So the DocuSign trade will continue until it hits one of the 2 posts, right? Either profit target or the stop loss. Or when the DTE falls below 30. Yeah, I will close the trade if the DTE of the long call falls below 30. All right. Let's continue because I have so many questions and topic here. Let's jump right in. And some of them I can be very fast, some of them I can be very explain in detail. Okay, Victor asked question number 1. Triple witching is when the stock options index futures and stock index option expire in the same date. Okay, so upcoming one will be March 21, 2025, right? From your experience, how does this affect the option prices with regard to the Greeks and especially Vega? Now you say especially Vega. I would say very minimum of effect on Vegas. You know what? Because the Vega impact will be very insignificant when the option is near the expiration, right? So Vega will be very impactful if it's for the long dated option. But when it comes to that date, when the option is going to expire, mm, the impact is very small. Yeah. For the net option credit strategy like bull put or calendar, how does it influence the underlying stock, meme stock, and marks? No, I cannot tell, but I mean, in general, on that day, what based on my observation, on the triple witching, sometime quadruple witching as well, the stock market tends to be volatile on that day. Like you can see opening up like big rally and then quickly reverse and then go up again, up down. So it keep going up and down in a very significant wing within that day. But it doesn't have very strong or clear data on whether on that day it will be uh, positive or negative. There's no such thing. Right? There's no like concrete statistic telling you that on that particular day, market tends to close lower or tends to close higher. There's no such thing. But the general sense is on that day, the market tends to be very volatile during the intraday. Yeah. Affecting stock depends. Of course, most of the stocks now move together with the broader market. So when the market goes up, it goes up. Market goes down, it goes down. So most of the time. So of course, it will affect on stocks, not just a meme stock, not just a Max 7 stock. Every stock would be likely affect because the whole market movement. Yeah. Same thing if your bull corn or whatever strategy you use that expires beyond that particular day, you don't have to worry about. The volatility only happen during that day and not beyond that. Okay. Sean asked question, I have a bullish synthetic trade and I sold corn. Yeah, so you have a bullish synthetic mean you buy a corn, you sell put. Now on top of that bullish synthetic, you will send out a higher call, making it like a cover call. That's correct. I call it the synthetic cover call. So instead of owning 100 shares and sell a call, now you converting the 100 shares into buy call and sell put, right? So that's a bullish synthetic. And then against that, you would serve as a holding 100 shares, you sell call option. So it's like cover call, right? So I call it synthetic cover call. Now, if your call is exercised and close, if my call is exercised and to close the whole trade, I will buy back the short stocks. Yeah. And then close the bullish synthetic. So correct. That's correct. You just buy to clear the assigned position and then also close the remaining bullish synthetic. That's correct. Palani, I don't know, Palani, sometimes we just call it Palantir, right? Palani, number three, is calendar spread similar to and even better than Casio put because it has a lower buying power and has lower limit has limited loss and can make money by converting into diagonal spread. So I can replace on my CPS or CSP with calendar spreads for above reason. And also, I do not want to own shares. And then whenever you ask this question in the future, right? Whether this strategy is better than that strategy, or what is the differences? What are differences between two strategies? The best way for you to answer your own question is just plot the P&L chart or P&L profile of these two trades on the same platform. And you look at the charts, you can tell yourself, obviously, you can tell yourself what is the pros and cons of each of the trade, right? What is the profit zone? What is the risk? What's the like max profit? So you can identify those features in the P&L chart, and then you can answer your own questions, right? So for example, now you ask this question, right? So let me just pick one example. So let's say Microsoft. You think Microsoft is now undervalued and trading at the low end of the range. You think it's a good way, good time to sell a Kaseki put, right? So then you can go to let's say April 4, and then you sell Kaseki put. Let's say you sell at 290 and collecting $5, right? So you just plot the chart. You just plot the chart of that trade on the simulation, Yeah, so here's a P&L of the Castle put, right? So that is one trade. This is something you may want uh, may want to consider, right? And then move this one to April 5th, so the expiration. So you have 77% chance of winning. Your break-even point is this. So anything like this you can identify, right? So that's one trade. The other trade is you say, okay, why don't I do a calendar spread whereby I buy like at the money expiring let's say August. So I buy at the money, which is let's say for 10, and then I sell a short dated option expiring, let's say March 14, 3 weeks from now. And also I sell at the same strike price, collecting $8 for it, and for which you have another trade. So here's a calendar spread, right? And calendar spread obviously has different shape and form of the P&L chart. So look at it, you will see the risk profile completely different, right? So what is the difference between these two? CSP, you obviously have a higher probability of winning, 77%, and you have your supply has to drop a lot for you to lose money, right? If it doesn't drop so much or stays here or even goes higher, you will be profitable, but your profit will be capped at about $500. Yeah, you cannot make more than that. And then you have to wait for um, more than a month to get that number. So that's one. The other trade, you can go to calendar spread and you see, well, now in this trade, I do not have that wide profit zone. My profit zone is smaller, right? And I have two loss zones actually. So my profit zone is between here and here. If the stock price drops a lot, I would be losing money. If it goes even rally a lot, I could be losing money as well. And I have only 36% chance of winning. 36% chance of winning. But if I'm lucky, I can make more than $500 profit, right? And the beauty here is I can run a short con for many rounds, so I can continue to run and collect more premium and generate even more profit than just $500. Yeah, and then another benefit of calendar spread is if the supply collapses, what happened? Well, my max loss is only $2,400. Yeah, I cannot lose more than that. But if I sell cash secure put and the stock price collapse, I could lose tens of thousands of dollars, right? The worst case scenarios is I lose $39,000, right? Minus five. So almost $39,000 if the stock price goes to zero in theory. But for calendar spread, I can sleep very well because I know my max loss is 2004. That's it. Stock price collapses, doesn't matter, right? So completely different profile. You cannot tell which one is better than the other. Yeah, cannot you cannot. Depends on your objective. You want to, but again, calendar spread. You need to roll. You need to be nimble a little bit. You need to make some judgment when you roll, whether you roll it up, you roll to the same strike price. So a little bit more advanced, right? Cash secure put is very basic, very simple. You get in, and if you the worst case scenario, you own the shares. That's it. But the risk is significant if the market goes through a big sell-off, right? Or the earnings will have a big gap down or something like that, then you could sit on a big loss. Because I know this because many people have sold classical put on some stock like 11 Health or like UNH, right? And the stock price plunged like 100 points. You lose $10,000 for one contract. Yeah. So it depends. You just need to practice for yourself and then you can answer your own question. Yeah, you can do boon put spread, but again, if you ask this question, just plot the chart and then you can answer yourself the same question. And boon put spread, you do boon put spread. And then you answer the same question. So let's say you sell 295 and you buy 290, plot the same chart here, not this one, okay, not the day here. Maybe boon put spread, you give it to April 4. You sell 290 and then you buy, sorry, 295, you buy 238. Sorry, I'm sorry. 395 and 385. And then analyze it. So if you ask, what is the boon put spread? Okay, different profile again. This one is similar to cash secure put. You don't have a risk on the upside,
It's
but your profit is
9:30.
capped. In this case, your profit is capped at $200, even less than Castle put. But the in exchange for lower profit, yeah, your loss will be capped. You won't have to deal with like $39,000 kind of risk. In this case, your max loss is $800. That's it. Yeah, so just plot those charts on the platform and you can answer yourself, right? That's very simple because every single strategy have its own P&L profile, and you just look at the chart and then you will see clearly which one has which advantage or disadvantage. Yeah. Continue, otherwise we will run out of time. What is the recommended net liquid value, cash buying power, we students need to keep in preparation for market correction at say 50%, 15%? How to calculate or look for net liquid value in Thinkorswim? First of all, my prefer uh, buying power that I use up to is 70%. So that means if I have an account at $50,000, I use up to $35,000, and I leave 30%, right? Not 15. 15 is a bit too risky. I leave at least 30% unused buying power there, right? Just in case some sell-off going on, then I have some dry powder there to pound the table. Now, how to look for it? Well, in Thinkorswim, it shows here, right? Net liquid. Just look at net liquid. Take a look at it. It's in here. So how to look for it? Here, it's here, right? So last month it was $50,000. Now it's 53. That's how you look for it. Okay, move on. I have so many here. Vincent, questions on preventing diagonal spread from stalling, which is like McDonald, right? Stalling. How do we prevent DS or DS hammer from stalling? What are the things to spot, consider before rolling, or short option that would lead to a stall DS or DS hammer? It seemed to happen a lot, especially after I rolled in the monthly short option, following the rule of 80 delta number of times. Yeah, it could happen. It could happen a number of times. I had a few trades like this, right? So Apple before, before the January, I have the same trade there. Now, how how do we prevent this from happening? Well, you ask this question, and it's similar to ask question. How can I prevent the weather from raining? No, you cannot. How can I prevent the rain from the weather from raining? Ask yourself that question. You see, it doesn't make sense. You cannot prevent. The price movement is something you cannot control. The stock price movement is something you cannot control, right? If you want to be sure the stock price won't, the trade won't be stalled, then don't enter a calendar spread, but enter a very bullish trade, like bull bang without any cap on the upside, or diagonal spread with a significantly higher strike price on a short call, then you have plenty of room for the trade to maneuver to the upside. But once you decide that the setup is neutral consolidation pattern, and hence you use calendar spread, there's no way for you to control how the stock price will move. I mean, your thesis when you enter, you think the stock price will go around like consolidating. In reality, it can move up, down, sideways. You never know. You cannot control it. So how can you prevent it? Well, yeah, same thing. If you think you can predict where the stock price goes, then you don't use DS summer. You use more bullish trade, like bullish synthetic, or you use like crouching bull, or you use like bull mark trade, right? It is more bullish than DSCS hammer. But if you ask, how can I prevent it from happening? No, you cannot. Because price movement is something you cannot control. Yeah. So if you think the stock price will move up very fast, then don't follow the 80 delta rule. Roll it earlier. Roll it earlier will be cheaper, and will be good, will be better for the trade. If you think the stock price is going to rally very strongly, roll it early. Don't wait for the 80 delta. Right. Number six, question on optimal remaining long quantity to close a trade. At which remaining long call left, it would be good to close a trade like CS, DS hammer. I would close it when it falls below 30 days, right? When the long call falls below 30 days, I would close it. Okay, Vincent, continue on structuring trade to roll monthly option. How would you structure and manage a trade like BBC, CS, DS hammer differently to roll the short option monthly instead of weekly for lifestyle fit? I understand that some of you may not have a lot of time on a daytime, especially you have a heavy work day or something, you don't have enough time for other thing. Yeah, I can understand it. So you may choose to roll it to a less like less frequently, less frequency than the like every 2 3 weeks, right? So in this case, my advice is, first of all, don't go for the stock that has no weekly option. Okay, even if you want to roll it on a monthly, just choose the stocks that have weekly options, because if you choose the one without weekly option, the liquidity is very low, bid ask is very wide, and option premium is not even good, right? So avoid those stocks. Still go for the stock with weekly options, but instead of rolling it for like 2 3 weeks or 1 2 3 weeks, you roll it out to 4 5 weeks, and you do it every 4 5 weeks, and that should be fine. And you say there's any particular type of stock that are not suitable for monthly rolling. So I just show you one example. This stock is very poor if you want to roll it for. So first on Unilever, right? It has no weekly option. Now, if you want to do the monthly rolling, yeah, you can. But you see, the premium is tiny. It's bid and ask is on the wide, and the premium itself is so tiny. It's not even worth doing, right? So even if you want to roll to sell this 155 strike price here, the exchange value. Look at the exchange value inside, only 42 cents. It's not even like 1% per month. So it's not even worth it. So avoid those kinds of stock that has very low premium and has no weekly option here. Sean, you asked question for bullish synthetic trades. Why does it not matter how much the debit we pay to open? Because at the expiry, we still have to make sure our price is above the strike price plus the debit to be profitable, isn't it? No, that is wrong. That is not the correct understanding. That's not the correct understanding. I never said in the lesson that you have to have the price to stay above the strike price plus the debit to be profitable. I never said it in a lesson. You must have interpreted in a wrong way. Never say it, right? So for example, I just pick one stock here, and why I say debit credit doesn't matter, right? So let me just use very simple example. Google right now, okay, Google is moving a lot. I will choose the one that's not moving a lot so that it won't affect the. Maybe I choose, okay, Google is fine. So let's say last Friday it closed at call it $180, right? So the typical bullish synthetic that I would do is I will buy at the money and sell at the money, right? Buy corn at the money 180 and sell corn at the money, sell put at the money, which is 180 also. So if the price stays at the same level as of last Friday, I enter the trade with let's call it zero credit, zero debit. Okay, make it simple. Zero debit, zero credit, because I buy and sell at the money, right? So imagine if I enter the trade like this, and on this Friday, when the option expires and the sub price close exactly at 180, then the trade will be break even, right? Right, break even because the call will be losing money and the put also losing money, and that will offset each other's, and I pay nothing at the entry, so I lose nothing. Yeah. However, if I enter a trade as a debit, so let's say instead of doing this trade, I will enter with buying in the money call, and then selling out the money put. So I choose 175 instead of 180, which is 5 points in the money. So I choose the strike price of 175, which is $5 in the money. So as a result, I will need to pay $5 debit for the entry. Now, if the stock price close on this Friday at 180, same scenario, close at 180. What do I have? Well, the put will expire worthless for sure, correct? Because it's out of the money. How about the call? Well, the call, the 175 call will be in the money. How much? By $5. So then the option value at the expiration is worth $5. Correct? Credit. Because in the money by 5, that means I can buy the stock at 175 and sell to the market at 180. So therefore I realize $5 profit. So on Friday, when the stock price closes at 180, I can sell my option to the market at the intrinsic value, which is $5. So imagine I enter the trade at $5 debit. Now at the close on Friday, I will sell it at $5 credit. So it offset each other. The trade would still be zero. I mean, the profit would still be zero, right? That's why I say it doesn't matter. It's you enter as a debit or credit or zero debit. It doesn't matter, right? So that's the beauty of synthetic spread. I hope you understand what I'm saying, right? This is a synthetic, okay? Continue. Number 9, Amy. For DS Hammer, if the stock is if the overstock overshoots the short call by a lot, when you cut loss, take profit, or when you wait for the stock price to retrace or roll to debit, or can you please okay. By right, if you construct the DS Hammer trade correctly, there will be no risk on the upside. There's no risk on the upside. So if the stock price overshoots to the upside, there should not be a loss, right? Question is whether it's making good profit or small profit. That's it. If you construct it correctly. Now, and your question is how you deal with that, whether you wrote it for debit or you wait. So exactly the same trade that I mentioned early on McDonald, right? It overshoots to the upside. And I wrote it up, but it's not fast enough. So the trade is stalled. Now, my dilemma right now is, do I want to roll it up further and pay a big debit to create more headroom for the upside and therefore turn the trade to a more profitable trade? Or I want to keep the trade right here waiting for the retracement, then roll, right? It's all about the art part of the rolling, the science and the art, right? So it's more on the art part, the judgment part, right? So I need to judge whether the stock price will go up further, which I need to roll, or the stock price will retrace, which I will be holding, right? So depends on the scenario. So example is a McDonald trade, right? Now the other trade that I did remember, SMH, I roll it up and the stock price goes up just enough, and that is the best scenario, right? So different scenario of price move, and then you need to make your own judgment on where you want to roll the short term to, and whether you want to pay a debit for it or you want to roll a little bit further for a smaller debit. It's up to you, right? Kevin asked question for rolling purpose. Under what condition we receive a credit when we need to pay a debit? So again, rolling the short call option is like this. It's like when you rent out your house, right? You rent out your house. Let's say you sign a contract, the tenancy contract with a tenant, and you say, okay, I agree to rent you this house for $3,000 a month, right? And the contract expires in a year, 1 year. Okay, so that is the first entry to the contract. It's like when you enter the trade. Now, 6 months has passed, and then now suddenly you see the market is very optimistic on the rental income, right? So most of people now raise their rent beyond 3,000 or to $4,000, $5,000. You say, God, now I'm sitting on this contract and the contract is still for good for another 6 months. So I need to. So basically, my rent is stuck at $3,000 a month for the next 6 months. All right. So now you have a choice whether you want to break the contract right here and pay a penalty for it with the intention to rent out your house earlier to another tenant at a better price or not. Right? So if you are bullish that you can rent it out at a much higher price, like $5,000 a month, you're okay to pay a penalty and break the contract with the current tenant, and then take the house back and then rent that house to another tenant at the higher price, right? But you have to pay a debit for it. So if you do that, that means you roll the call option at the debit. You buy back the call option at a loss, right? At a loss. You pay a debit for the rolling with the expectation that the stock price will continue to go higher. Now, of course, there's no guarantee, right? There's no guarantee that the stock price will go higher. There's no guarantee that you can rent it out for $5,000. So worst case scenario is you break a contract, you pay a penalty for it, and then you could not find a tenant, or you could not find a tenant that pays you more than $3,000. So that's the worst case scenario, no? Right. So it depends. It's your judgment, right? Whether you are confident that you can rent it out for a higher rent, then break the contract, pay a debit. Yeah. Vivian asked Coach Bang, please can you show us rolling an IBKR for calendar spread and how to add the break even in option analysis in IBKR. I don't think you can add any break even in IBKR, right? But I can show you how to roll it on IBKR. For example, so let's go to my account here, one of my account when I have a new trade. Let's say I have a Disney trade, which is the calendar spread, right? Calendar spread here. You see, I have a Disney calendar spread by August and sell March 7, right? So if there are two ways for you to roll in IBKR, you can, my preferred way is to use the strategy builder here. Strategy builder. Just go to the one that expire the short option you want to close, and then you roll it to the higher strike, let's say, right? So you go to the short option, March 7, buy it back. So one leg. And then let's say you want to roll it to the following week at the higher strike price, let's say 112, and you sell. So this is a rolling order. This is a rolling order. You buy back to close the existing short call at 110 here, and then you sell to open the new one, and then adjust the contracts here and adjust the price, and then send it out. That is how to do it on IBKR. Yeah. So for this one, perhaps you have to pay a debit for it. Adjust it to this one 5 contracts, and then submit, set. Right. One way. Sometimes you can do it the other way as well, but I prefer this way. The other way is you right click on the leg that you want to roll, right click on the march here, and then roll. Roll. And then you choose the new one you want to roll to. So in this case, you want to roll to March 14, and then sell the new one, 112, and it gives you the same thing. Exactly the same order that I just showed you earlier. That's how you do it on IBKR. All right. TP asks question here. How to better manage trades during sudden market dips? Is there any warning sign that we can watch out for? How to better manage trades during sudden market dips? Just follow your trading plan, right? So whenever you enter a trade, always have the exit plan, right? My exit plan always, what is the profit target? What is the stop loss? I just follow these. And then if hits one of the two criteria, then I will just exit the trade. Or sometimes it like my long call is running low in terms of the DT, I could close it early as well. But most of the time I close it either at my profit target or at my stop loss. Yeah. Is there a warning sign that we can watch out for what? For the market dip? If you ask this one, then it's similar to say, okay, when you're driving, right? Is there a way for me to, is there a warning sign that there will be bumpy road ahead. Yeah, yeah, you can look out for. Or is there a warning sign on the road that tell me that potentially there's some accident or risk ahead of us? It's very hard to answer that question, right? Right. Well, you can look at for some traffic signs, or you can look at some of the observation of the weather or anything, right? But no one know when the risk will come. No one know when the market will tank. No one know that tomorrow the market will be up or down. Okay, next one, Shane. How to manage number 13. All right. So number 13 here. How to manage calendar spread when prices gap down? Do you close a trade when the price suddenly drops more than a certain percentage, or just follow the 50% loss rule? I follow the 50% return on investment loss rule, rule. But normally I don't close it at the spot. I mean, I wait for the day to close first, and then I will take action in the following day. Yeah. How much of it depends on the long dated corn expiry? Now, okay, good question. At times, when the gaps is too steep and the supply like nose dive, right, to significant lower number, then my trade could lose more than 50%, way more than 50%. Let's say it suddenly gaps down and I lose 85% of the trade. Yeah. And then I have only 15% remaining value. Question is, do I want to cut loss right here, or do I want to just hold on to it, waiting for a recovery? Well, it depends. If the long con still have a long time to go, like 120 days, 150 days, there's no point to cut loss at that point in time. There's not much risk to the downside. There's not much value to lose. Then just maybe just hold on to it. And who never know, in the next 120 days, 150 days, thing can turn around, right? And then the trade can stage a comeback, right? So I tell you two examples, right? I have one calendar spread on Celsius holding, right? I enter the trade as a calendar spread 35, right? 35 strike price. And it drops on the way to 25, significantly lower. So my trade my trade did not lose much, because you know what? In the early days when I entered the trade, I have been able to roll the shotgun multiple rounds and collecting enough credit and profit that even now, if my trade expire worthless, I would not even hit my stop loss. So I kept the trade on because of that reason. It did not hit my stop loss, but the stop price went on the way down, way below the strike price 35. So I left my trade there for that. I say left for that. I mean, there's not much to lose, a few cents left. Suddenly, last Friday, the stock price went significantly up because of good earnings and the announcement of acquiring competitors, right? And suddenly my trade almost turned around. Not turned around, but the loss reduced significantly. And there's still like 4 weeks to go. So things can turn around from here. So that's the thing, right? When there's not much value in the trade, just leave it there. Just leave it there. And thing can happen and it can quickly turn around. The other trade I had is on UNH, right? UNH, I entered the trade. I also rolled it a few rounds, and suddenly the price gap down significantly on last Friday because of DOJ investigation, and the trade lost like 80%. Well, I look at it, I say, do I want to sandwich the 20% remaining value or not? But I look at the long con, still 120 days. I say, okay, I kept it. Because, I mean, in the 120 days, many things can happen, right? The earnings coming, there will be some appeal on the investigation. There's something new news, and then I mean, there's so many things that can happen in the next 120 days. So I decided not to cut loss on a trade because that's not much. It's not like investing, right? So Adam exit 100% his position on UNH because he's concerned on the income may be inflated, and there could be some fraud, there could be some accounting issue, there could be some headline issue, risk for a long time. And that is understandable because he talking investment, right? So long time holding big position, the risk on the downside is significant, right? Quite significant. If the stock price continue to go lower, then he could be losing a lot of money on that. So that's why he exited the position. I think that makes sense for me. In my case, my risk is well defined because I use calendar spread, which the risk is capped and it's already lost 80%. There's like 20% value left. How much it can lose more, even if it goes to zero, I lose few $100 more. And there's 120 days to go. So I decided to keep the trade, right? So different trade, different risk profile, then you have different decision. Okay, number 14 from Shane again. When considering taking profit on calendar spread, even if the 50 to 70% return on investment rule is met, do you also look at the implied volatility as a factor in deciding whether to continue holding the position until the last 30 days? Now, not the implied volatility, but I will consider other factors like earnings, right? If my trade is already generated 50% or 70% return on investment, good profit, and the earnings coming, I typically take the money off the table, close it, remove the risks. Because with earning, anything can happen, right? So, but not implied volatility. Yeah, not implied volatility. Or when the long con DT is falling short, right? 30 days or less, then I can close the trade early to take the profit. But not implied volatility. All right, next one, tiny creatures. I like this name. Number 15, I believe many members here starting account with IBKR. We would really appreciate if Bank can show more trade analysts, P&L win percentage, etc., to build our certain and confidence that we are doing the right thing when doing ourselves. Okay, so that's what first part of the question. Number one is on the Microsoft. Now the first part, right? In case you're not aware, I have the videos on how to use IBKR to analyze trade using all the strategies that we are teaching in the curriculum. Every single strategies. I have the videos from how to use IBKR to analyze it. Now, if I use IBKR today to simulate the trade, I would do the same thing as I did in the video. But I prefer to use TOS because it's clearer, it has more data and features. So it will be more effective for me to use to use TOS to demonstrate the trades. I have 64 trades idea today. Now, if I have to use IBKR to demonstrate, perhaps I can finish only 1/3 of that, right? So it could not be a good use of my time and your time, right? So the best use of your time will be go back to the video and watch it because I have all the videos for it. Now, having said that, I have to admit that IBKR analysis tool is not as good as TOS. So that's one is for sure. It's a known fact. Everyone knows it, right? And I don't know why IBKR cannot improve their analysis, right? But I also feel frustrated with the lack of the features that they have, right? There's no winning percentage. There's no winning percentage on IBKR. So you ask me to do it on IBKR, I don't know how to do it because they don't have it. They don't have like percentage of the probability. They don't have it, right? So they lack some features there. So even if I demonstrate it, I cannot do it. I cannot show you. Yeah. Now the second part of the Microsoft trade. Looking at Microsoft is on sideways, very good setup on CS, but I have doubt because the current prices support area has been tested many times. Could it break the 407 level support? Now, I don't know. Okay, later on there are a number of requests or trade ideas on Microsoft. So I will revisit the technical setup of Microsoft anyway. In case you want to know, it's in there, right? So I will cover your questions there, But I look at the chart of Microsoft right now. I still think okay. It's still, I mean, having some support here, as you say. So your concern is it can break down below here? Impossible.
It's 10 o'clock.
But I'm still uh I still in a view of the view that this is a strong support level and it could bounce off this level and go up from here. Yeah. But I can be wrong now, but trading, right, is all about probability, right? There's no 100% guarantee one way or the other. We just need to form our opinion based on a certain thesis, and then we stick with that, right? If you're afraid of the price will break below that, yeah, don't trade it. Don't trade it. Yeah. But I have a view that I think it will hold this support level. Christopher, number 16 here. Trade suggestion on BBC or BB. Okay, later on there will be some trade suggestion for the woman color, so I will cover that, right? Depth, you asked number 17 here. Comparing Jet Lizard versus Boom Put Spread, which one is better? What scenarios and why? Again, same question that some people asked earlier, right? Whenever you ask questions on compare these strategies with that strategy, just plot these two on the chart, and then you can tell yourself what is the difference, what is the advantage of this versus that, right? The risk profile, the profit zone, the max loss, max profit, they're on there, right? Not just these two, right? Just go there and plot the two chart on the platform, and you will see the difference. Yeah. KS number 18, what is causing the implied volatility to increase or decrease? Is there any indicators, method of detecting it in advance? So this is the question. This question is similar to what caused the markets to go down or up? Exactly the same. And when you ask me this question, I ask you the same. What caused the markets to go down or to go up? Oh, there's so many factors, right? That could happen, right? Trump say something, Elon Musk say something, uh, Putin say something, right? There's so many things that could cause the market to go up and down, or Fed chair announce something, right? Or you can say, is there any indicator that detecting that in advance? Then you ask yourself a question, is there an indicator that tell you that the road condition ahead is not good? How could you know? Yeah, there's something like some accident happen in front of you, or some bumpy road because of the raining or because of weather condition, something. Is there any indicator? Sometimes you can find, sometimes you don't, right? How can you know if Trump's going to say something before he says, right? How can you know if Fed chair will or the CPI report will be hotter or colder than the expectation? So those are the things that nobody knows for sure, right? So don't waste your time on this. MF, I don't know, 2634. What does it mean? For ESS, can the four trades, I think you mean four legs, be closed at the same time? Do you recommend closing one side first, or no? Close on together, four legs. Exactly what I did for the one mark trade, right? I enter four legs together and I exit four legs together. Don't split that, because split that means you cannot control the net price, and therefore you cannot control the profit or loss for the trade. Yeah, always in and out, four legs together. It's harder to be filled. I know, but it's the best way to execute a trade. Tiny creatures again. Do we have a website platform to track the ticker on daily IV and volume of the option trade, like top 10 and top 20? I'm sure out there are websites where you can find those piece of data, right? The pieces of data. I don't use it. I don't use those data points. So that's why I don't have it on top of my mind. So you do Google, you search it out, or you ask ChatGPT, perhaps you can get it there. But I don't have it at hand because I'm not using it. All right, number 21 from Jen. My favorite strategy is DS Hammer, but I found the break-even point is too close to the current price. Yeah, correct. So I often change a short sell to a lower delta, which is like 35-40 instead of 20. Is that okay? Yes, it's okay. But keep in mind when you sell a lower delta strike price for the call, I mean you get more premium, right? Therefore, you cushion the downside more, and therefore your stop loss is lower. So that's the benefit. But the trade-off will be you cap the upside. You cap the upsides maybe a bit too much. So if you do that, it's likely that your trade would have some loss zone in the upside. So if it overshoot, the price overshoots to the upside, your trade will be losing money. Yeah, so that's a trade-off. If you want to use different strategy that has a better the better what is it break-even point, perhaps you choose like iron condor or boom boot spread or calendar spread. Again, calendar spread is similar to what you're saying here. Yeah. They're always trade-off, right? They're always trade-offs. All right, so J8L number 22. In the lesson on calendar spread, it was mentioned that we can roll the short call higher or lower than the when the price moves out of the profit zone. May I know why we cannot roll the short call lower than the long call for calendar spread, but not for okay. Nowadays, I have the same rule. Calendar spread, diagonal spread, DS hammer never roll the short call lower than the long call. I know in the old time, I used to roll the short call of calendar spread below the long call. But I experienced many times the stock price spike up, right? And that it hurt the trade significantly. Yeah, it hurt the trade significantly. So now I have the same rule. Long for calendar, diagonal spread, and DS hammer. Don't roll the short call below the long call. JHL again, number 23. For trades involving a long-dated long call like DS Hammer CS, it's recommended to close the entire trade when the long call has less than 30 days to expiration due to time decay. That's correct. In the lesson or the Boon Con spread, the recommendation of DTE to open the trade is 30 days. May know why the Boon Con spread recommendation is to open the around 30 days when the time decay would be working together. It's a good question, but these two trades are very different cases. These two trades have different cases. Boon con spread, you have to be very bullish to take the trade because you have the time decay works. You have the time decay to work against the trade, as you say here. So boon con spread, you need the price to go up fast enough to offset the time decay, which happens every day, right? So the price bet needs to go up very fast. Otherwise, the trade will be losing money. Now, the reason why we don't recommend a too long DTE for the Boon Con spread is this. If you choose too long DTE for the Boon Con spread and the stock price goes up a lot, you won't be able to get the max profit or the good profit until the DTE is near the expiration. The max profit can only be achieved when the stock price goes beyond the short call and expires, right? That's the max profit. So if you choose like very long DTE for the bull call, you have to wait. Even if you get the direction right, the profit will come very slowly. And only the profit only comes to near the max profit when the DT is running low. Yeah. So does that mean you need to wait? And when you wait, there could always be a risk that the stock price will pull back again. Yeah. So that's why we recommend to have a shorter DT for the bull call. But you have to be bullish to take the trade. If you just like moderately bullish or you like neutral on the trade, don't take the bull call because the time decay will hurt the trade. Yeah. Then number 24, in back ratio strategy, is there a way to remove the dead value dip? Have you done testing on this strategy and what are your findings? Is it cheaper than calendar sweat and DS hammer? So okay, so that's the first part. Okay, let's address your question uh, on the first one first, right? So you know the P&L chart the of the break ratio spread looks like this, and then you have that valley, and then you go here like that, right? So break even is somewhere here, right? So your question here is, can we eliminate this that value, right? So imagine if you can eliminate that value, that means the trade will have no loss zone, right? So if you say if you hypothesize that way, your trade would become like this one, and your trade will never lose any money. So it's a no risk kind of trade. And in my experience, it's very rare that you can get a zero risk trade. Very rare. There's no such thing. There's no free lunch here, right? So you always need to have some trade off. There's a profit zone, there's a loss zone as well. If you have on the profit zone for the trade, well, I will do nothing else but that trade, right? So I will just ignore on the other trades. I just do one trade that you want to do, which is no risk. But in reality, there's no such thing. Now, in the video, Adam showed multiple lines to show different date, when to exit, how to set up. Well, in IBKR, I don't think you can do, but in the thing of swim, you can do it here. Just like at expiration, you can choose many steps, right? You can choose expiration 1, 2, 3, 4 step. You can do day steps, different days. I don't use it because I can always simulate the time passing by changing the timing below here, and I have different pin curve. But you want, just go here and choose these lines. You can do that way. PY number 25. Recently, United Health falls on DOJ probe into Medicare billing. The IV percentage is high. Is it a good time to sell cash secure put now on UNH? Okay. When you ask this question, you ask yourself, do you believe that UNH is still a fundamentally good stock? That's it. If you answer that question for yourself, then you know the answer for this question. If you still believe this UNH is a good stocks to hold in the long term, and the current stock price decline is just a short term challenge, then sell cash secure put, because that is cash secure put is the strategies that allows you to own the stock at a discount potentially, right? And you don't mind buying it, right? But if you think that the DOJ investigation can reveal something fundamentally flawed in the business model, right, or the financial statements, and that could bring down the intrinsic value of the stock significantly, then don't do it. Yeah. So then if you follow Adams, he exited, right? So but he wrote a note that he still believed in the long term this can return, but in the short term he feel uncomfortable holding the stocks of the company that has what is it? He call it unhealthy culture or something, right? Then you just need to form your own opinion. If you still think this is a good stock to own, then keep selling. But keep in mind, this stock can still under scrutiny and headline risk for a long period of time. even the whole thing is still very, I mean, recent, right? It's not settled down yet. So, and I've seen many people holding the bag on a similar stock, which is Element Health. Many of them sold Casicule put at $500 strike price, and now they sitting on a significant unrealized loss, right? So there's always risk on the Casicule put, right? Even on the stock that you think fundamentally it is a good one, but it can take a long time for the stock price to go to its intrinsic value. Like some of the student has helped to Alibaba stock for 3 years. Finally, they get back to above the water, right? But you have to wait. You have to wait a long time. So I don't know. For me, I would not touch it. Jan number 26. Does the premium cost based on stock price? My capital is small. What is the best way to select $100 stock? Yeah. So in general, the premium is percentage of the stock price. That's correct, right? So the higher the stock price, the more premium per share that you can get. So that is correct. So if you trade high price stocks, that will block you a lot of capital. So that's for sure, right? If you trade like Netflix or Meta or Microsoft, it could block you a significant capital. But there are many stocks that allows you to trade at more affordable capital, like Disney, like Citigroup, right? Wells Fargo, many stocks that is around $100 ish, right? Many of them, right? So you can find it. I mean, if you have a smaller account, yeah, I would suggest you start with a low, like $100 stocks and not like 500 or 1,000. Yeah. Terry, question number 27. For strategies like CS, DS Hammer, BBC, how can I preview the new P&L chart on IBKR before rolling in the short con in my portfolio? Risk Navigator, I cannot change anything. So let me demonstrate one example. Again, I have the Disney calendar spread here, right? So let me show you before and after rolling in the analysis tool. So go to new window and then go to risk navigator and open, let's say, my portfolio. Okay, just open the new window here. All right, so now choose the underlying, which is Disney only. I choose the Disney stock only. All right, so I have the full portfolio with many trades, but I only focus on the Disney. This is the trade that I'm having on my portfolio before rolling. Right, so before rolling, you can see the P&L looks like this. Right, you can zoom it, it looks like this. Yeah, so with the break-even point between here and here, something like that. Now you want to know what is a P&L curve after rolling, right? So let's say I plan to roll this one up. I want to close this leg, which is a 110 call expiring March 7th, and I roll it up to, let's say, 112, expiring the week after, right? So I want to roll it, and I want to preview the P&L before I roll, right? So then go to here, and then how to add the new one. Oof. Oh, it's very interesting. Okay, let me go back here. It should allow me to add the new leg here. I don't know why. Okay. Okay, let me do it again. Okay, go back to this one. Let me do another way. New window, portfolio analysis tool, risk navigator, and new what if. Okay. And then yes, so it will pull my portfolio with it. Okay, now I think I got it now, right? All right. So this is the one. Then under this, I will choose the Disney trade. Yeah. So now I have this new, then I can add the new leg here. So if I zoom the P&L curve right now, it has the P&L, the break even between, let's say, this and this. And I want to simulate the rolling order. So rolling means I close this one, I will sell the new one. Let's say I sell the 112 expiring March 14, right? So I add new Disney option, and I want to sell March 14 and 112. Yeah, so there I have it. So now rolling means I will sell this one. I sell mean I will untick this one. Yeah. And then I buy to close and I untick that one. And I sell to open the new one. So I need to type in like 5 contracts, which is a, yeah, so this is a new trade. So after the rolling, my P&L curve will look like this. Right. So we'll look, because when I roll it up, so I create more headroom for the upside. That's why the trade has a significant upside and essentially no risk on the upside. So that is a P&L curve after rolling. Right. Now, this curve doesn't capture the realized P&L of the short call. Because when I close the short call here and I open the new one, what this chart doesn't capture is whether the short call that I close here will be closed at the profit or the loss. It's not captured here, right? So right now, this trade I entered just a few days ago. Let's call it time decay has. I think the time decay has happened. I think it's already. Oh, I can show you here. So this 110 is making $615 unrealized profit. So when I close it now, I will close it and realize $615. And that chart should add 615 on top. So the real curve of the P&L should look like this. All right, so the difference should be like $615. Because the moment I roll, the platform will remove the realized P&L of the closed leg. And no of any of trading platform allows you to do to keep the P&L of the rolling. No platform, as I know. I have Tasty Trade, I have Thinkorswim, I have IBKR. None of them allows me to keep the P&L of the rolling of the roll legs, right? So you have to mentally add the rolling P&L on top of the curve to understand the real P&L of the trade. But you can do this, right? All right, so that is from Terry, number 28, Quang Hui. Number 28, current market is quite volatile. During Trump 2.0, which strategy of option trading are recommended to use? If you're afraid of too much volatility within a day, stick with the risk-defined trades like the one I'm using, calendar spread, diagonal DS hammer, and boom bang colors, or even boom put or iron condo is fine as long as it's risk-defined. And avoid doing some undefined risk trade like cat secure put or trade lizard or couching bull, right? So that's one way for you to do. But volatility also good. Volatility will bring the premium of the option, and therefore you sell it, you get a better premium. Okay, TH Tell ask question here number 29. For strategies like CSDS, you need to roll on a regular basis. How do you determine the price of the new roll call? Is it based on the one standard deviation and the duration 1 to 2 weeks? Yeah, so my preferred duration is 1 to 2 weeks. At maximum, I goes to 3 weeks because if it go to 4 weeks, it becomes too slow. I mean, the time decay benefit is not there, not much. So I prefer to roll to 1 to 2 weeks. That's why you see I keep rolling to 1 to 2 weeks because time decay in the short run will bring profit very fast, right? How about the new short call? I mean, ideally, if you know where the stock price goes, you just roll the short call to that level, right? Because the max profit is achieved when the stock price goes to the short call and expires right there. Yeah. Now, in case I don't have any bias, I have no idea where the stock price goes. I just sell a new one standard deviation out of the money. Yeah. If I'm bearish, I sell a lower one. Yeah. If I'm not bullish, I just sell a lower strike. TP in IBKR, how do I determine the probability of success of the trade? No, you cannot do it. I say, I don't know why IBKR doesn't have it. GH, Adam just posted his comments on Intuit a few moments ago. Will it impact our current open trade on Intuit in option trading? How do we balance or make trade decisions from impacts of news, technical analysis, and fundamental analysis? Now, if you remember, we have the Intuit trade here. Yeah, remember we have this trade, and the supply has dropped 35 points, right? And still the trade is profitable. Now, Adams posted the one post in his channel saying that, okay, there's a small possibility that Trump could abolish uh, the IRS, right? IRS means the tax revenue bureau there. So there's a chance that remote chance maybe that he could remove that agency, right? And therefore, and then at the same time, he would like reform the whole tax code so that it makes the whole like tax filing process much simpler, right? And therefore that will affect the Intuit business, because Intuit business, a big part of their profit comes from the TurboTax, which help people to file a tax filing on a yearly basis. So if that happens, that could potentially impact Intuit business. Now, I think the new is there for some time. It's not the new thing, and that could explain why Intuit stock price has moved the way it's moved, right? It has moved down quite steady over the past 2 months or so because of that news. So the news has been surfaced for some time now. It's not the new thing, but it's still going on. So that's why market is still nervous about the impact on the stock price. Now, if you are in the camp that yes, it could happen, and then it would tank the stock price significantly from here. Yeah, and then in that case, you know what? Just close the trade, take the profit and run, because our trade is profitable anyway, right? So if you're really afraid of that happening, then just close the trade, take the profit, release capital for new trade. I probably do it as well before the earnings. However, I'm holding it now, uh, and I will consider that before the earnings, because earnings is on 25th, actually tomorrow, right? Tomorrow. So later on, when the market opens, I may close the trade, or I may wait until tomorrow and close it tomorrow, and I let you know. There's a good chance that the stock price can, yeah, still be flat today. Maybe I close it later, take the money and run. Now, I'm not afraid of Trump's um his intention. I think it's very low probability for me, because abolish IRS that means you screwed up the agency that is now bringing money to you every single day, and it's a big part of government budget, right? If you do something like so disruptive to the home agency there, the tax revenue could be impacted heavily, and then that will make things even worse. So I think if any happen, it could happen gradually. It's not like very disruptive, right? So I'm not afraid of that. I'm just afraid of this thing, because the stock price is so below below the current strike price of the trade, the 600. So the next round when I'm rolling, I will not be able to roll for a good premium. And that could be the reason why I may exit the trade, not because of Trump, not because of Trump. Yeah.
It's
Now, of
10:30.
course, if the earning is good, and the stock price jump close to the 600, that would be the best for the trade. But that is something we don't know. Yeah. Now the market is opening at 10:30 right now. We have a quick break, 10 maybe 5 minutes break. And then when we come back, by the way, that's all the topics that I have. And the next one will be trade ideas. So when we come back after the break, we will review our trade to see if we need to take any action. And then we will go to trade ideas. I see you back in 5 minutes.